Hello and welcome to the 2025 open enrollment period for Gundersen benefits in 2026. My name is Michael Swartz. I'm a certified financial planner and physician development coach here in La Crosse, Wisconsin. Of course, it's Emplify Health now by Gundersen, but I'll be referring to these as the Gundersen benefits, at least for this video here in 2025. So we'll kick off first with what's changing for the year, and then we'll follow the benefits guide that is provided to you for open enrollment between October 21st and November 10th of 2025. Your elections will take place and go into effect January 1st of 2026. So with that, let's jump into what's changing in 2026. So we'll start with the health and well-being. General benefit deductions. It seems like a handful of people may have been on the every 2 weeks payroll instead of twice a month. So everything now will change to 24 times a year. So the first and second paycheck of the month will take deductions for your healthcare FSA, dependent care FSA, or HSA contributions. Under the medical, wigs are covered now up to $1,500 once a year, and then lodging and transportation up to $10,000 benefit for transplant or CAR T therapy. Gundersen First Health Plan, they were offering virtual physical therapy at no cost for anyone over the age of 18. And this one is certainly worth highlighting, the HRA. So from what you may recall, Gundersen had what used to be called the cost share fund that was moved into an HRA. If you have not been on the Gundersen First plan since they moved to an HRA, it is possible that you would forfeit your HRA balance if it is frozen for 3 years. And so what Gundersen is trying to tell you here is if you do not enroll in the Gundersen First plan in 2025 this year for calendar year 2026, you will forfeit your HRA balance. So for those of you who had a cost share fund who got moved to an HRA, pay very close attention to this. If it was frozen for 3 years, it will be forfeited. So this is the year to look very closely with that. If you moved off of the cost share fund and onto the high deductible healthcare plan and not the Gundersen First plan, watch out, don't lose your HRA. Finally, flex spending accounts. IRS has not published those yet for 2026, but they have updated the dependent care flex spending account. So for those of you with childcare costs, it is going up significantly from $5,000 in 2025 to $7,500 in 2026. Again, those are use it or lose it. So if you are going to have $7,500 in dependent care expenses, those expenses that come from daycare or babysitter costs, for you to be gainfully employed, you'll want to take advantage of this account. It does not cover babysitters or evening coverage, only for coverage, childcare coverage that allows you to be gainfully employed. Next, the health savings account, the deductible, or excuse me, the contribution limits will be going up from 4,300 to 4,400 for individuals, and from 8,750, or sorry, from 8,500 to 8,750 for the family. Keep in mind on this health savings account contribution, I will be talking about all of these from a family perspective. So this 8,750 number, but there are a few nuances that I'll just point out right now. Gundersen does contribute to your HSA $1,000. That will deduct $1,000 from what you can contribute. So if Gundersen puts $1,000 in, you can only put in 7750. Additionally, there is an over the age of 50 catch up where you can put $1,000 in if you're over the age of 50. So your contribution amount will actually go back up to 8750, even though Gundersen puts that $1,000 in on your behalf if you're enrolled in the high deductible healthcare plan. So keep in mind, it does say you do have to be in the high deductible healthcare plan to use an HSA. The 8750 limit is reduced by 1,000 for those who get the $1,000 contribution to the HSA, but it is also added back in for those of you over the age of 50. So a few tax planning items there. And then for bereavement leave, extending bereavement leave to include perinatal loss, including miscarriages, this will also be included. So that's a big one for those who are struggling with family planning in their lives. So that's all the updates for this year is what's changing for the 2026 benefits. And with that, let's jump into the benefits guide. All right, here we are, the 2026 Benefits, Enrollment, and Information Guide, as I mentioned, for open enrollment from October 21st through November 10th. This is kind of those 6 factors that Gundersen or Amplify Health by Gundersen will be offering to you in your benefits. We'll just follow them through chronologically. And this year, I did offer last year for folks to actually reach out and schedule an open enrollment meeting who were not clients. It was phenomenally successful. I'm grateful for everyone who signed up. But this year, I will put a link to schedule the discovery meeting with me if you would like. But I would ask that just only folks who are genuinely considering working with me as a financial planning client would schedule those meetings. I won't be offering open enrollment meetings to folks who are not planning clients this year. But I appreciate everyone who took me up on that offer in previous years. So when we look at the total rewards, we talked through kind of what Gundersen tells you from a human resources perspective, what they think they're giving you or what they are giving you from a total benefits, not just compensation. Obviously, that is number one, but there are a lot of other benefits. And I will say this again. I said it on last year's video. I've worked with clients across the United States. They've gone to different regional healthcare centers or sometimes even Hawaii or out to New York. And Gundersen or Amplify still offers one of the most robust compensation packages, total benefits packages that I've seen. And so, yes, the straight up W-2 income, that compensation piece may not be the highest it is nationwide, but from a total employer standpoint, these benefits are some of the best. So they include the health and well-being programs, the disability insurance protection, the 401k plan, and then the life benefits program to help you be your healthiest self at work, home, and community. Not 100% sure what that means, but I think they really do strive to take care of their employees. And of course, the growth and development with continuing medical education, things of that nature. So as a whole, one of the best benefits packages that I've seen as a CFP. All right, for open enrollment, step one is obviously to learn. You can go to gundersen.amplifyhealthbenefits.org. You go to resource for the open enrollment guide that we're going through, going to a benefits fair, or reading the bridge brief. These are all great resources, or you can just watch this benefit video. And then step two, plan, and then step three, enroll. So if you have any questions, obviously talking to coworkers is very helpful, but ultimately I do recommend that you talk to either a certified financial planner or tax professional when you're considering some of these different cost benefit analysis details for some of these benefits. So if you do get a chance to talk to a professional, either your financial planner or even your tax preparer, they can certainly have some input on what some of these best practices are for you. And then obviously you go into Workday or gundersen.amplifyhealthbenefits.org. It does say, assistance with Workday open enrollment, but ultimately you enroll through Workday. So with that, let's get into not just what's changing, we did cover that, but the biweekly payroll deductions, the WIGs and lodging and transportation coverage, the physical therapy for those over the age of 18, and of course, that big one, the HRA. Don't forfeit your HRA balance that came over from the cost share fund. If you have any questions, reach out to Human Resources so that you don't lose that, especially if your cost share fund held a significant balance. Continuing, the flex spending account, IRS limits have been noted for the flex spending account. So this is a medical or healthcare flex spending account. These are use it or lose it. So an FSA, you only want to put money in there and get a tax deduction on the contributions for money that you will certainly be using in the calendar year of 2026. If you don't know if you'll be using it or not, it's a bit of a risk to put money into an FSA because there's a very small carryover that you can have, but everything else is just stripped out of the account, taken away from you. You don't own it. You must use it in the calendar year. Same thing with the dependent care FSA. That limit went up from 5,000 to 7,500. That is significant. Again, all the money that you put through these FSA accounts becomes untaxed or can be contributed pre-tax. So essentially, the federal government and the state government won't be taking your highest marginal taxes out of the account. So if you make $200,000 a year and you're paying 22% in federal taxes and 5% state here in Wisconsin, you save 27% on any money that you put into these flex spending accounts that you ultimately use for their intended purposes, so for healthcare or for childcare. Whereas the HSA, this health savings account, it follows the same tax rules. So you do get untaxed dollars. So you untax the dollars that you put into these accounts. However, the health savings account is actually under your social security number. You get to keep it, you can retain it, you can invest inside of it. So when I start talking about the different healthcare plans, I'm going to really speak to the specific benefits of a health savings account, and they are significant. So it does seem that Gundersen or Amplify is really pushing folks onto this high deductible healthcare plan, and utilization of the HSA is a very beneficial planning tool. So we will talk about that in greater detail. I am going to skip over the bereavement leave, paid time off, and floating holidays. These are the general benefits, but I know there's a lot of nuance between departments and professional status within the hospital system. So make sure that you understand your bereavement leave, paid time off, and floating holidays for you as a professional, dependent on your role within the system itself. All right, we'll go through and skip over the benefits basics, but we'll jump right into the medical coverage. So Gundersen is only offering two medical plans this year. Here we are on page 8. It's the Gundersen First Plan and the High Deductible Healthcare Plan. In the past, the Gundersen First Plan has had a very low deductible. That's here. It's not that much different than the high deductible healthcare plan this year. It's only $900 different per individual and just $1,800 per family. And so when we start talking about the tax benefits of being on the high deductible healthcare plan, receiving a $1,000 contribution from Gundersen to your health savings account and being eligible to contribute to an HSA, every everything is pointing me towards telling clients very strongly consider enrolling in the high deductible healthcare plan first, especially because the insurance coverages aren't significantly different. Now, I have had specific cases where clients have certain prescription drug coverages or physical therapy or treatment plans that are covered by the Gundersen First Plan 100%, whereas they're not with a high deductible healthcare plan. So if you have a specific question on that, again, I encourage you to reach out to HR. But in general, the deductibles are not materially that much different. And everything that I see here is really encouraging almost every and any all healthy individuals to take on the high deductible healthcare plan. And we'll talk about that in real numbers. So go through the coverages that are here. But again, most things are almost identical. And so that really leads me to saying, okay, if the high deductible healthcare plan is even questionably in your best interest, it's very likely that it is. And here's the reason why. So I'll be talking about all of these values for the employee plus family. But obviously, there's employee plus children and employee only. But as we talk about it from an employee plus family perspective, when we look at the Gundersen First Plan, if you're a full-time employee or over a 0.75, the employee plus family plan is $359 per month. If we multiply that by 12, that's over $4,000 per year in premiums alone. That means that it costs you $4,000 just to have this insurance. And I'll remind you, the deductible is only $900 lower. So as a quick educational tool, the deductible is the amount of money that you pay in medical costs for costs incurred without any help from insurance. So that deductible amount is 100% your responsibility before insurance starts taking over and paying about 80% of your medical bills. So if it's only $900 difference and you pay $4,000 more to have your family on the Gundersen First Plan, there should be a very good specific reason why you're on the Gundersen First Plan. Meanwhile, the high deductible healthcare plan is only $88 per month. Multiply that by 12, it costs you just over $1,000 per year. So right there, if you switch from the Gundersen First Plan to the high deductible plan, you're saving $3,000 per year just in premiums alone. And the best part about the high deductible healthcare plan is Gundersen is going to contribute $1,000 to your HSA through myhealthequity.com. So not only do you pay $1,000 or just over that amount for high deductible plan coverage, you get $1,000 back in credits towards your HSA from Gundersen. So this plan ends up costing you $4,000 less when you include the difference in premium and the HSA. So again, $4,000 in savings, more money in your pocket just by enrolling in a high deductible healthcare plan. So I would really encourage folks to say, do I have a $4,000 benefit for being on this Gundersen First Plan? It's possible, but I would say, speaking in generalities, it's not very likely. So when we go down here, prescription drug coverages, here's one of the benefits of being on the Gundersen First Plan. You do not have to meet the deductible to start getting coverage for your prescription drugs. So if you have a lot of prescription medication, this was the specific example I was speaking to earlier, where being on the Gundersen First Plan actually made sense because these prescription drugs were $25,000 to $50,000 a year for this specific client. Since they didn't have to meet a $3,400 deductible on the high deductible plan before they got that prescription drug coverage, it actually made sense to be on the Gundersen First Plan. So in that specific case, it did. But in general, once the deductible is met, all the coverages by the insurance is the exact same. So the out-of-pocket maximum here is treated differently since they start taking care of you before you meet your deductible. And so the prescription drug maximum out-of-pocket for the individual is $3,000 on the Gundersen First Plan and $6,000 for the family, but it's just combined with a medical max out-of-pocket on a high deductible healthcare plan. And just as a quick reminder, we'll scroll back up here. The maximum out-of-pocket for individuals on the high deductible healthcare plan is only $1,800 more, and for the family, only $3,600 more. So again, is $3,600 a lot of money? Absolutely. But if you're saving $4,000 in premiums, you're still $400 ahead, even if you met your family maximum out of pocket. So that's where the prescription drug coverage may be the contributing factor to having folks elect the Gundersen First Plan. All right, next we're going to talk about these HSAs and FSAs. So if I haven't lost you yet, a flex spending account or an FSA are those use it or lose it accounts. An FSA you can put money into, it is untaxed, so it either goes in pre-tax or you contribute post-tax dollars and receive a credit on your tax return. But an FSA you must use by the end of the calendar year, and there is only a small rollover amount. So with the HSA, Gundersen is going to contribute $1,000. With an FSA, Gundersen doesn't contribute anything. As you know, and as we've talked about, the HSA contribution limits for calendar year 2026 will be 4,400 for individual or 8,750. And as I mentioned earlier in the video, age 55 or older, there is an additional $1,000 catch-up that you can contribute. So per individual is 5,400 or 9,750. This is where I would strongly encourage you to reach out to a tax preparer or a financial professional to evaluate the cost benefits of enrolling in an HSA plan versus the Gundersen First Plan with the FSA. The Gundersen First Plan should be included with the FSA. The high deductible plan should be thought about with the HSA. So if you enroll in the high deductible healthcare plan, I strongly encourage all of my clients to max out their HSA if possible, because that will kind of compound the tax benefits of being on the high deductible healthcare plan. But you should speak to either a financial or tax professional when you're evaluating those coverages. So again, Gundersen's going to remind you, you can contribute to an HSA or a 401k, but these are 100% tax deductible contributions. Both the HSA and a 401k will have tax-free earnings. You can take reimbursements for all qualified medical expenses. And so the HSA is a really robust tool to kind of offset some medical expenses, especially during your working years. As a reminder, Gundersen will not put any money into your FSA, but they will put $1,000 into your HSA if you are enrolled in the Employee Plus Children or Family Plan. Again, age 55 plus, yes, there's $1,000 catch up. And again, that nominal carryover, only $660 carries over if you enroll in the FSA. So basically use it or lose it, except for that $660. Whereas the HSA, you own it outright. It is your money in an HSA account. It is under your Social Security number. So even if you separate from service, that HSA is still your account. But you must be enrolled in a high deductible healthcare plan to contribute to the HSA. And I think repetition is the key to learning. So I'll just keep reminding you, high deductible healthcare plan, HSA eligibility. All right. So both the FSA and the HSA will be administered by Health Equity. You can log into myhealthequity.com to check those balances. And the other thing that's extremely valuable about the HSA is that you can invest inside of it. So before we get past the dependent care FSA, I do just want to talk a little bit about that. So typically what I recommend is that clients keep 1 year's worth of either deductible or maximum out of pocket in cash within their HSA. Everything above that can be invested. It actually grows tax-free and can come out tax-free for qualified medical expenses. So if you're comfortable with investing even in a money market that grows at 4%, a very conservative investment, you can grow your money within an HSA tax-free. The only other type of accounts that allow you to do that are 401ks and IRAs. So that's a very, very cool benefit of the HSA. It's called triple tax deferred. The money you put in is tax-free, the growth is tax-free, and the distributions are tax-free, provided they come out for qualified medical expenses. All right, moving on to the dependent care FSA. You cannot invest in this, but this is essentially a pass-through account, a clerical account, where you can take money from your paycheck, put it into a dependent care FSA first, and if you reimburse yourself for qualified child care expenses, you can receive that money in your bank account tax-free, provided you pass it through this dependent care FSA first. And once again, not $5,000 as it has been in the past few years, but actually $7,500 per family each year. So a significant increase. Make sure, once again, with an FSA that you're going to be using that money if you plan to utilize the dependent care FSA. All right, moving on to dental coverage now. So we've got two plans to evaluate here. We've got the enhanced plan and we've also got the basic plan. So the enhanced plan is going to cost $98 per month or just under $1,200 a year, whereas the basic plan is only $43 a month or $500 a year. The reason this is relevant, and again, I'm only speaking for those full-time employees who are enrolling their entire family. I think it's the easiest way to compare the numbers. But generally speaking, $1,200 for the enhanced plan and only $500 for the basic plan. Why would you go on the enhanced plan? Well, if you intend to have a major reconstructive surgery, a crown, an implant, a root canal, you want to be on the enhanced plan. You want to get that full $2,000 benefit. The basic plan is only a $1,000 benefit. So if you're just planning on having basic cleanings in the coming year, I'd stick with the basic plan. You pay $500 and you get up to $1,000 in benefits. So, yep, you get your cleanings covered and about a $500 benefit net of premiums going towards your dental. However, if you're on the enhanced plan and you have a major dental event, then you have a $2,000 benefit pool. So it's worth paying that extra $700 in premium to tap into an $800 net coverage instead of a $500 net coverage. So when I say net coverage, it's just the total annual maximum benefit minus those premiums that you pay for actually having the insurance. The other big thing here is orthodontic services. So the basic plan does not offer orthodontic services. So if you have children or you yourself plan to have orthodontia in 2026, you will want to be in that enhanced plan. All right, so that wraps up the health and dental coverages. Next, moving on to life and accidental death and dismemberment insurance, or AD&D. So the only time that I recommend AD&D insurance, accidental death and dismemberment, is if you are ineligible to receive personally owned term life insurance. So if you have a pre-existing medical condition that prevents you from going out into the marketplace and buying your own term life insurance, AD&D may be for you. I typically don't recommend it for healthy younger individuals because the actuarial tables don't actually support using AD&D insurance. So not enough people claim this benefit to make it financially viable as something I would recommend in generality. However, the life insurance piece is certainly worth diving into. So Gundersen is going to offer you 2 times your annual earnings up to a maximum of $250,000 on their behalf. So they're going to pay this amount for you. Please note that they can pay up to $50,000 of coverage tax-free, but anything above that, so 200 up to $200,000, when they pay that premium above the $50,000, it's called imputed income, and you will see a small taxable event on your paycheck. It's still a phenomenal way to get very, very inexpensive life insurance, but I just want to point out here that's what that imputed income is if Gundersen pays for insurance more than $50,000 on your behalf, you claim that premium payment that they pay on your behalf as earned income, and you owe the taxes on that. It's a fraction of what the cost would be to have that insurance, so absolutely take it. Don't let that imputed income scare you away from taking the full $250,000 in life insurance coverage. Now, as we talked about employee supplemental life and AD&D, unless you're ineligible for supplemental life insurance, I do not recommend getting the AD&D, the accidental death and dismemberment. However, I do recommend looking into supplemental life insurance through the group rates if you can. So every single insurer now is requiring, for the most part, I don't want to say absolutely, but for the most part, insurers are requiring that you show proof of insurability to be on supplemental life insurance policies. And so it is worth looking into. Is it more cost effective if I want additional life insurance to get it through group life insurance offered through my employer or from the marketplace? So you can go to some place like Symetra or Lincoln and buy your own personally owned term life insurance policy. And if you want additional life insurance, I'd recommend doing your own cost benefit analysis on buying it through Gundersen or buying it through the marketplace. But either way, you can get very low cost, high coverage. I think for a healthy 40-year-old right now, $1 million in term life insurance might be $400 to $500 a year. But each one is based on your health history. They do typically require underwriting to get additional life insurance. And so if you do elect it, just expect that as well. So that's that evidence of insurability right there. Spouse, domestic partner, supplemental life, and AD&D, same conversation as with the individually owned. Look at what the group rates are. You do have eligible evidence of insurability requirements typically. And so just compare the group rates to the marketplace rates and go on somewhere like Lincoln or Symetra, compare which one will be more cost effective. And if you want supplemental life insurance, compare the cost of the two and just pick the cheaper option. All right, next we're going to talk about disability insurance. So short-term disability, this is going to be offered to you. It's going to essentially be either based on your income or a salary continuation, depending on which one you fall into. The general benefits here are going to talk about the short-term disability where you're eligible up to $2,500 per week, up to 12 weeks. And so this coverage paid by the employer, and it's taken out of your benefits that you receive, and then you receive that as a taxable benefit. So it's essentially the same as a salary continuation, but it's only 60% of your basic annual earnings. So for those of you who are on this short-term disability program that's in the benefits guide, you will receive a 40% reduction in your income, but since it's employer paid, it's something that you will receive and is a wonderful benefit that Gundersen offers. So they don't require you to take out your own short-term disability policy. And typically they've got the picture here. It's with labor and delivery. So expecting moms can get 60% of their income for that full 12 weeks after delivery. Obviously, there are other ways that you will be eligible for short-term disability, but this is obviously the most commonly used claim on short-term disability. Now, employer paid long-term disability. I want to talk specifically to this. So there's a long list of different ways that Gundersen offers long-term disability, but we'll just talk about the specific benefit here. They cover up to $10,000 per month, which is 60% of your annual income, which will be $6,000 a month in a benefit to you. So 60% of that $10,000 is $6,000 per month. That's the maximum. There's a 90-day waiting period, so that's basically equivalent to that 12 weeks that you'd be on short-term disability. Once you're off short-term disability, you end up on long-term disability, and this benefit pays to age 65. So something certainly worth looking into here. Now, here's additional monthly limits for executives, clinicians, associates, professional staff, and exempt staff and leaders. So keep in mind that $10,000 benefit does not apply to these other coverage groups. All right, so one thing I do want to talk about is what option we want to select on a long-term disability. I often recommend clients pay taxes, so elect the taxable benefit. So when you log into Workday, this is how I recommend clients fill out this radio button election spot. So every year I get plenty of questions on this. Should I pay taxes on the premium for the long-term disability benefit that Gundersen is paying for? And the answer for me is typically yes. Here's why. If you elect the non-taxable benefit, you will not be taxed on the premiums. That means you don't have to pay any taxes while you're getting the insurance coverage paid for on your behalf. However, if you ever use the long-term disability benefit, that benefit will be taxable to you. So even if it's $6,000 a month, or if it's more, you will have taxes taken out of a larger amount of money while you're on the long-term disability insurance program. Whereas if you select to enroll in the taxable benefit, you would receive that long-term disability insurance payout tax-free. So when we jump back over to the benefits guide, and we see here that executives have up to $20,000 in long-term disability benefit, that tells me that if you pay the taxes on the premium, you very quickly recoup the cost of paying the taxes if you ever are on the long-term disability insurance program. In fact, I ran the numbers last year, and for anyone who works even for a 30-year career paying taxes on the premiums, the break even was like 2.5 months. So if you receive a tax-free benefit from the long-term disability insurance payout, you would recoup the costs and the taxes that you paid on that benefit even after 30 years in just 2.5 months. Now, you do have a 90-day elimination period, so you would have to be formally disabled for about 5.5 or 6 months. But I do want to point out one thing here. The average long-term disability claim is 2.5 years. So in my mind, if you were ever unfortunate enough to have to use the long-term disability benefit, even if you've paid taxes on those premiums, as I recommend, this number here, where we select the taxable benefit, you make that up very quickly and you stand to benefit tens, if not hundreds of thousands of dollars by being on a taxable premium and receiving a tax-free benefit. So once again, while you're in Workday, this is what I recommend for my clients. It's likely appropriate for you as well. We're going to waive the non-taxable benefit and we're going to select the taxable benefit. In the event that you use that long-term disability insurance, you will receive a much, much larger payout every month that you are on long-term disability. So especially as you approach the later part of your career, paying the taxes on that long-term disability benefit becomes a much more mathematically advantageous option to take. All right, moving on to the employee choice benefits. The accident insurance is very much like an Aflac policy where you pay a small monthly premium. And then if you have any of the following services, you get paid. I typically don't recommend this except for the hospital indemnity insurance for expecting mothers. So if you know you're going to be delivering a child in 2026, paying for the hospitalization policy, this one here, an admission pays you $2,000 if you're on the high plan. And the premiums for that on the high plan, employee only, is only $8 a month. So you pay $100 for the year to receive $2,000 for a hospital admission. Other than that, it's typically just gambling on whether or not. Now, if you are strapped for cash, if you're a tight cash flow family, this might be a good hedge against, a catastrophic event. And so if you're either expecting or going into the hospital would be a significant issue for you to overcome, then I would say absolutely look at having the accident insurance offered by Unum. But in general, I don't offer this or recommend it for most of my clients. And again, $240 for the high plan for the year for the family, with the possibility of hospital admission paying you $2,000. So there is a potential that this would help you. in the event that you have an event. But if not, it's a pure cost to you. So up to you to decide on this one. There actually are some benefits, and I do recommend it for some clients. Critical illness, I typically do not recommend taking this one. You can look at it and see what the benefits would be. It's fairly inexpensive, but once again, you're gambling on getting sick, and I typically don't recommend it. And again, with the hospital insurance, this is the one that I would recommend for expecting mothers, where you can pay $22 a month and again get a $2,000 benefit if you're admitted to the hospital. So please look at these ones, and they are worth looking at. I don't typically just blanket statements say go ahead and waive those, but absolutely worth looking into if you're expecting, or if you have a high prone to risk if you're prone to risk, or if a hospitalization would be a significant threat to your cash flow and financial well-being. As for the rest of the benefits, ID Watchdog, I typically don't recommend. This is a identity theft program, but I typically don't recommend it. Same thing with the legal administration. If you do have a legal event upcoming and would benefit from this, it may be a good idea to do, but generally speaking, talking to someone who knows your specific situation is generally the recommendation that I make to clients as well. Pet insurance, I've actually never pursued this with the client. You do have to provide the age, type of animal, etc. There's no blanket coverage here. You actually have to apply for and then get a quote for it. I don't recommend it, but if you do have a geriatric animal and it's late in the year and you know that they're going to have additional services, I'm pretty sure they still do underwriting similar to the evidence of insurability, that EOI for life insurance, where the higher risk your animal is, the more likely it is that they will use this insurance. Therefore, it's more cost ineffective. It's going to cost you more to have the insurance. But if you have a lot of animals and there's a possibility that you would use it, once again, look into it, but typically I don't recommend this for any of my clients as well. All right, moving on to the Gundersen 401k retirement plan. This is a really cool structure to the plan because they have something that isn't as typical as most employers. So Gundersen is going to offer you a 4% match on a 5% contribution. So if all you can contribute is 3%, they will match the 100% of the first 3% you put in. But if you can go up to 5%, they'll match 50% of those next 2%. So you have to do either 3 to get 3 or 5 to get 4. I even have some clients who like to put in 6 to get 4, so just 10% of their salary is going into their 401k each year. And one thing that's really cool about the design of this plan, once again, Gundersen having some of those more employee forward benefits, you are always 100% vested, not only in what you put in, but in the employer match. That is not typical. Typically, employers will wait to let you keep what they put in on your behalf as an employee retention tool. But Gundersen says, hey, that's yours 100%. If we match it, you can keep it. However, Gundersen does do the profit share as well, and that is on a vesting schedule. So here they say if you're less than 2 years and we put in a vesting contribution, or excuse me, if we put in a lump sum contribution through the profit share, you don't get to keep anything if you've been here less than 2 years. After 2 years, you get 20%, and it's a 20% increase through year 6. So once you've been there 6 years or more, this is a moot point. You will get to keep 100% of the profit share that they put into your 401k on your behalf. So the 401k plan is pretty awesome, in my opinion. I would also say One America, who monitors the plan, is a wonderful resource. One thing I would point out here, to log in, you do not go to oneamerica.com, you go to oaretirement.com. So keep that in mind. Do not log in your 401k through One America. Go to oaretirement.com. And if you have any questions about how to invest your 401k, how much you should be putting into your 401k, and how you should be managing Roth versus traditional contributions, that's what certified financial planners help you do. So if you'd like to consider working with me, I'd be happy to talk about the 401k plan with you in the context of a greater financial plan and how to manage it early in your career, how to invest it mid-career, or even how to get distributions out of the retirement plan as you approach retirement. So there's a lot of levers that you can pull here with your 401k. And as a professional certified financial planner, I do know what those are. If you want to retire early, there's some really cool ways that you can structure your retirement income with your 401k. So if you're looking at retirement and thinking about doing something with it, feel free to reach out and schedule a meeting, and we could certainly answer some questions that you have on this. Finally, they're going to provide you with just some general contacts, and thank you for reading through the Gundersen benefits package. So with that, I'll conclude the Gundersen benefits video for this year. Highlights of the plan. Dependent care FSA increases from 5,000 to 7,500. Do not forfeit your old cost share fund. If you're in the HRA balance, group of people, so someone who had a cost share fund who became an HRA, please make sure that that account was frozen for 2 years and that you enroll in the Gundersen First plan so that you preserve access to those HRA dollars. One other smaller point on the HRA, it is really interesting. They will actually be processing those claims automatically. In the past, you had to submit your expenses and they would reimburse you for 50%. Now those will actually be automatically claimed through My Health Equity, so you don't have to go through and submit the claims on your own behalf. Other items to keep in mind. Long-term disability, we do recommend the taxable option. We went through that whole situation. 401k has an awesome 100% vesting schedule on any employer matches, but not necessarily on the profit share. And when it comes to the entirety of the benefits package, again, Gundersen has one of the most beneficial packages as a total compensation package that I've seen, even compared to Mayo here in La Crosse. Gundersen does have a phenomenal benefits package. So with that, I want to say thank you for watching the benefits video. Again, my name is Michael Swartz. I'm a certified financial planner and physician development coach here in La Crosse, Wisconsin. And again, my contact information is below if you'd like to schedule a meeting with me or reach out via email if you're exploring a financial planning relationship with someone who could help you even in your early years of your career, all the way up to and through retirement. You can also check out healthwealthness.com. That's my marketing brand where I publish a lot of podcasts. I've written a book and have a lot of resources for physicians who are at every stage of their career. It's health and wellness for physicians from residency through retirement. So with that, thank you for watching the 2025 Gundersen benefits video and good luck with open enrollment.